I just want to talk at the beginning, if I may, about the interest rate decision, because I think that's going to be something that so many of our viewers are going to be really concerned about. And we had the comments, of course, from the Governor of the Bank of England warning us to expect a higher interest rate rise next month. What should we be bracing ourselves to see?
I think there's actually been a bit of misreporting of what Andrew said in Washington yesterday, because he was talking about the interest rate decision relative to what they were expecting back in August when they did their last monetary policy report. So he wasn't saying interest rates are going to have to rise even more than we thought last week. Really, he was just reflecting the fact that the pressures on interest rates have risen in the past couple of months for reasons we all know, what's been happening in Ukraine and the mini-budget. And he was merely saying to his audience that they would need to be raising bank rates. So I don't think people should read anything from that into their mortgage rates or anything. What is at issue for their mortgage rates is really what's happening to market interest rates. They've already moved up in anticipation of the bank's future decisions, and also reflecting the turmoil in bond markets which followed the mini-budget the other week.
I mean, you're talking there about the turmoil in the markets following the mini-budget. I mean, whenever I have government ministers, here in the studio, they try and really talk about the global forces, which you acknowledge too, in Ukraine and the energy prices. But it is correct to say that a lot of this turmoil is directly caused by the government policy that we've seen.
Yes, frankly, I think it's disingenuous to say it's all a global phenomenon. It's not. There is a global element. If you look at the general level of interest rates, they've risen by about 3 percentage points since the beginning of the year. 3/4 of that, 2/3 maybe, is the world and what's happening in the Ukraine, but the rest of it is a UK-specific phenomenon. And it's particularly developed since the mini-budget. So it's clearly driven by that, in my view. And basically, we've moved from looking not too dissimilar from the US or Germany as a proposition to lend to looking more like Italy and Greece.
Right. Well, that says it all, doesn't it, really? What did you make of the new Chancellor's comments yesterday? Do you think they will have gone some way to placating the markets?
Well, I thought he set the right tone, and importantly, he recognised that there were some difficult decisions ahead he was going to have to make pretty quickly, I have to say, in the next couple of weeks, on both taxes and spending. And the important thing to realise, it's not simply just a case of changing the identity of the Chancellor or bringing forward the Office of Budget Responsibilities report. It's actually the contents and how the numbers add up. And even before the mini-budget, in the medium term, there would have been a hole in the public finances of 30 billion or so, to which the government layered on another 45, subsequently reduced to 43 billion. Now, they've done a U-turn on a little less than 20 billion of that. So there's still 40 billion they've got to find from somewhere. That's very chunky. So that's why he's right to say there's some very difficult decisions. And the crucial thing will be whatever is published in a couple of weeks' time on October the 31st is coherent, and that the markets see there is a viable and plausible plan for making everything fit together.
I always feel that, in these kind of political shows, you end up throwing around numbers, 40 billion, and it's quite hard to realise what the enormity of what we're talking about. I mean, 40 billion pounds. Can you put it in any context, the kind of squeeze that we'd have to see to fill that gap? OK, well, 40 billion is about 2% of annual production of the UK. A cut in income tax of 1 percentage point, which is one of the things that was in the mini-budget, bringing that forward 1 year, that costs about 5 billion. So 40 billion is quite a lot. If you want to think about it in terms of government spending, you're getting on for 5 or 6% cuts in government spending. And it should be said, obviously the government are talking about efficiency savings and stuff like that. The existing cash limits were set a year ago when inflation was expected to stay low. Pay increases in the public sector were expected to be 2 or 3%, which is not sustainable now. Pay in the private sector is growing at about 7%. So already there is a big squeeze in real terms on public spending. And if you're going to layer more on, that has to mean real cuts. You can't find it from eliminating waste, which will no doubt be the mantra. But there would have to be serious decisions about things to stop doing.
Serious decisions, including potentially about the NHS. I was interested to read your comments about, if you wanted to get the share of government spending to GDP down, you have to be prepared, say, to move away from our own health service, free at the point of delivery, to one funded by social insurance.
I have to, again, slightly mischievous reporting. This was part of a long interview with your economics correspondent, Ed Conway.
I have to take it up with him.
But the essence of the point that I was making is that actually the share of government spending in GDP hasn't changed very much over 50 years, but beneath the surface there's some very big trends, and in particular the share of health and spending on welfare has risen from about a quarter of that to half of that, and that largely reflects demographics. We have an older population, and we've also decided to pay them better pensions. That's going to continue in the future. In the past, that was accommodated by falling defence spending, falling debt interest spending, falling public capital investment. All three of those elements are programmed to go in the other way now. So it's a challenge even to hold the share of government spending constant.
And to actually make cuts.
But to make cuts, the point that I wanted to stress is you have to decide, actually, we want to do things differently. You can't achieve these things simply by finding a billion here, a billion there.
Do you think we are in a recession? Or do you think
in terms of the indicators, the economy is pretty much flatlining to slightly contracting. Looking forward, I think it's pretty inevitable that there will need to be a period of contraction. How big, we don't know. But in some sense, there needs to be, because the labour market is very tight. Vacancies are still at a very high level. And that reflects the fact that 500,000 people left the workforce as a result of the pandemic.
And if we see a squeeze in public spending and in the fiscal tightening, could that make the recession more difficult, longer?
Well, if you have a tighter fiscal position, that tends to mean lower demand, lower output. But there's an offset to that, because the Bank of England can then run a looser monetary policy. So it's the flip side of what we saw with the mini-budget. So the mini-budget was basically something that was going to expand demand, but in order for the Bank of England to meet its inflation target, it had to offset the consequences of that by prospectively raising bank rate more. So you can change the mix, but the overall level of demand has to be consistent with the economy's supply capacity.
Just finally, we'll have Andrew Griffith on the show a little later. He is one of the few people to have survived in the Treasury under Kwasi Kwarteng, and also the new Chancellor, Jeremy Hunt. What would you ask him? What would you like to find out?
Well, I would like to find out what their plan is for, essentially, if you like, making the numbers add up in the medium term. So given that they want to have the ratio of debt to GDP falling 4 or 5 years out, presumably, what is the balance they're going to strike between raising taxes or cutting government spending? And if the latter, how they were expecting to achieve it.
That is the big question indeed. Thank you so much. It's been
You're very
fascinating
welcome.
to talk. Pleasure to have you on the programme.